Hi guys, so we're coming up to the end of the financial year and it's tax time again. And so a few people have been asking me, how do these tax deductions work when I own a property investment? So what I thought I would do is put together a little short video for you to show you how we can calculate the tax deductions for owning a property investment in Australia with some estimates on the price of the property and some of the deductions that are available to you. So this isn't an exact model that's going to be accurate for everyone. It's only conceptual. So, but it might be very handy for you guys to know this as you're coming into tax time. If you're either looking to buy a property investment to manage your tax, get some deductions, or whether you already own one. So we'll start out with the property investment acquisition. So the property investment acquisition might be $500,000. If you're living in Southeast Queensland or investing in Southeast Queensland, might be $1 million plus in Sydney. Whatever the case may be, on $500,000, there's going to be some money attributed to the borrowings of $500,000 if we're fully financing the property purchase. And that means that the bank over here is going to ask or require for some interest. Now, interest rates are about 4.5% at the moment, being 2016. 4.5% or 4.6% multiplied by 500,000 roughly is $24,000. That is what you're required to pay the bank for that loan for your property investment purchase. But because you're not living in the investment, there's a tenant that's going to be living there, and the tenant will actually pay the rent to you, and that will be income. And the rent is going to be around about $24,000 per annum based on a yield of about 4.8 to 4.9% gross. So we have income, which is taxable, and we have an expense, which is deductible because this is for investment purposes, not your own home. There are other deductions we can calculate though, because the interest cost is only one of many. I'm going to tabulate them here and explain how they're calculated. So first and foremost, we have the interest cost of $24,000 per annum. Then we have around about $10,500 in depreciation expenses. Now depreciation is split up into $6,000 for the construction portion of the property, which is the 2.5% that you hear about, and then we have $4,500 depreciated every year attributed to the fixtures and fittings inside the property, like the ceiling fans and air conditioning and so on. So when we add those two together, this is the bricks and mortar portion, and this is the fixtures and fittings portion. And when we add them together, it comes to around about $10,500. Okay. We also have loan write-off expenses, which are quite small but inclusive. And then we have $6,000 in operating expenditure. Now, operating expenditure includes insurance, rates, water, and property management. So when we add all those costs up, it equates to roughly $6,000. If we add all those up, we come to a total deduction of 24, 34.5, 36.5, $42,500 in gross tax deductions off your assessable income. So if you were making $100,000 in income and we deducted $42,500 from that $100,000, you would only be taxed on the balance, which is around about $57,500, which means you'd have a really low tax rate or tax payment to make every year. The issue is that we can't deduct the full amount off your assessable income because over here we're making money from the investment and that's fully taxable. So we have to add back, it's great to deduct 42, but we have to add back the 24,000 from the rent. And that will calculate the net deduction that we can take off your assessable income, which means we're at 18,500 net deduction. And a fast way to calculate what your tax savings is going to be is to take the net tax deduction and multiply it by your average tax rate. And someone on $200,000 a year, the average tax rate is going to be in the vicinity of about 37 to 38%. And if we take that average tax rate, remember it's not your highest marginal rate, it's your average tax rate. Take that, multiply it by the net deduction, and that will equal somewhere in the vicinity of about $7,000 per annum in physical, actual tax savings. The beauty of this is that the depreciation expense here of $10,500, it's a deduction where it's non-cash in nature, so you don't have to spend the money as such to get the deduction down the bottom here. So it's quite handy to have coming into your bank account every year or every month if you've got a tax variation set up, to be able to facilitate and fund the operating costs. Now your $7,000 a year in tax savings can actually fund or pay for the bulk, if not all, of the operating costs of holding a property. So you can set it up and then you can have the tax savings assist you to hold the property long term so it doesn't put you under any hardship financially. And that's certainly something we would want to explain to our clients and make sure they have the correct tax advice from their accountant or from an associated accountant that we can refer them to. So I hope that gives you a bit of an indication on how the tax savings work. Again, it's just very basic, conceptual. It's not advice, it's just information for you to take away so you know a little bit more about the benefits of owning a property investment in Australia.